What happens to the global economy if the world's most important oil choke point suddenly stops functioning? Not slows down. Not gets disrupted for a few days while diplomats make phone calls and markets price in some uncertainty. Actually stops. Because that question, which most people have spent their entire lives assuming was purely hypothetical, is no longer hypothetical. It is the live scenario playing out right now in the Persian Gulf. And a Goldman Sachs analyst has said publicly, on the record, that the economic damage already accumulating from disruptions to this corridor is irreparable, and that no policy response currently available to any government on Earth can stop what is already in motion. When analysts at that level use language like irreparable, they are not being dramatic for attention. They are describing a mechanical reality about how the global economy is structured and what happens when one of its foundational assumptions fails. To understand the severity of what is happening, you need to start with the supply chain picture, because the oil disruption is only the most visible layer of a much broader structural problem. Global supply chains are not just disrupted in the energy sector. They are disrupted across the entire physical commodity complex. Natural gas flows that move through the same regional corridors as oil are constrained. Fertilizer production, which depends heavily on natural gas as a feedstock, is being affected. Metals and petrochemicals that move on the same shipping routes are being repriced and rerouted. Ships are in the wrong places. Vessels that were contracted to carry cargo through now dangerous or uninsurable routes have been diverted, creating cascading delays in supply chains that have nothing to do with oil, but depend on the same global shipping infrastructure. Marine insurance, which is the invisible infrastructure that makes commercial shipping economically viable, has been canceled or suspended for significant portions of the affected region. When insurance disappears from a shipping route, commercial operators do not sail that route regardless of what their customers need or what prices they are offered. The liability exposure is simply too large. And when ships stop sailing, the cargo those ships were supposed to carry stops moving, and the factories and refineries and distribution systems that were waiting for that cargo begin shutting down in sequence. This is not a theoretical cascade. It is the cascade that is already running. The Strait of Hormuz sits between Iran to the north and Oman and the United Arab Emirates to the south. At its narrowest, the usable shipping channel is roughly 2 miles wide in each direction. Through that corridor, under normal operating conditions, flows approximately 21% of the world's total oil supply and roughly a third of all globally traded liquefied natural gas. The numbers are almost impossible to internalize at first pass. One choke point, 2 miles of navigable water in each direction. 21% of all the oil the world burns every single day. There is no pipeline network that can substitute for this volume. There is no alternative maritime route that can absorb it. The Cape of Good Hope route around the southern tip of Africa can handle some rerouting, but the transit time adds weeks to journeys that currently take days, and the global tanker fleet is not sized to operate at the scale and speed that would be required to compensate for a full closure of the strait. The countries most immediately exposed are the Asian economies that have built their entire industrial models around reliable, affordable energy imports flowing through this route. 89% of the oil moving through the strait's major choke points flows toward Asian markets. Japan, which has no domestic fossil fuel resources whatsoever, depends on this corridor for the energy that powers every factory, every train, every hospital, and every household in the country. South Korea, Taiwan, India, and China all face versions of the same structural exposure. Saudi Arabia exports the overwhelming majority of its oil production through this route. The Gulf Cooperation Council states whose sovereign wealth funds are deeply embedded in global financial markets derive their entire economic foundation from oil revenues that move through this corridor. When analysts talk about the Strait of Hormuz as the most important economic choke point on Earth, the data fully supports that description. There is nothing comparable in the global trading system in terms of the combination of volume, concentration, and absence of viable alternatives. The scenario that energy analysts are now modeling seriously, which would have been considered an extreme tail risk just months ago, involves oil prices reaching $200 per barrel or potentially higher if the closure becomes prolonged. It is worth working through what that actually means in practical terms for an ordinary economy. because the number itself can feel abstract until you trace its consequences through the supply chains that connect it to daily life. At $200 oil, gasoline prices in the United States would reach somewhere between $7 and $9 per gallon based on current refining and distribution economics. That is not a number that stays in the transportation sector. It is a number that travels through the entire cost structure of the economy. Shipping costs for every physical good that moves by truck, by air, or by sea would increase by roughly 40% based on industry estimates of fuel as a share of total logistics costs. Airlines would face a catastrophic cost structure that would force significant capacity reductions, route cancellations, and in some cases operational suspensions. The aviation industry operates on margins that cannot absorb a doubling or tripling of its primary variable cost without fundamental restructuring. Food prices, which are already sensitive to energy costs because of fertilizer inputs and transportation, would increase by 30 to 50% within weeks according to analysts modeling the transmission effects. Heating costs for residential and commercial buildings in regions that depend on oil or natural gas for heating would roughly double. And all of this would happen simultaneously in every sector, in every country that is integrated into the global trading system, which is essentially every country on Earth. The second-order effects on supply chains extend well beyond transportation costs and deserve explicit attention because they tend to be underappreciated until they are already causing visible problems. Oil is not just fuel. It is the molecular foundation of the modern industrial economy in ways that go far beyond burning it for energy. Fertilizers are synthesized from petrochemical feedstocks. Remove affordable fertilizer from global agriculture and crop yields decline, food production falls, and prices increase in ways that disproportionately harm the poorest populations in every society. Plastics are derived from petroleum. Plastics are in medical devices, packaging, construction materials, electronics, automotive components, and thousands of industrial applications that the modern economy cannot function without. Pharmaceuticals depend on petrochemical inputs at multiple stages of their production processes. The disruption being discussed is not a disruption to how people fill their gas tanks. It is a disruption to the feedstock that makes the physical infrastructure of modern civilization function at its current scale. Australia, to take one specific example that illustrates the geographic reach of these effects, is now facing a serious jet fuel supply problem because China has banned fuel exports, affecting 32% of Australia's jet fuel imports. Singapore's jet fuel prices have doubled. These are not countries directly adjacent to the conflict. They are economies on the other side of the world feeling the transmission effects of disruptions in a waterway they have no direct military or diplomatic role in resolving. Financial markets have begun pricing in the severity of what is unfolding, and the positioning data tells a specific story about how sophisticated capital is reading the situation. Hedge fund short exposure in U.S.-listed ETFs has surged by 23% in just the past month. Total short positioning is at levels that historically have appeared in only 3% of observations over the past 5 years, meaning the current level of bearish positioning among institutional traders is more extreme than 97% of what has been seen in that time frame. Short positions are expressions of a view that prices will decline. When professional investors operating with significant capital and sophisticated risk management systems are taking on short exposure at historically extreme levels, they are communicating something specific about their expectations for the economic environment ahead. This is not retail fear. This is institutional conviction expressed through risk capital. The fact that it is happening simultaneously with the physical disruptions unfolding in energy markets is not coincidental. It reflects the analytical judgment of professional market participants who have modeled the transmission from energy shock to inflation to Federal Reserve constraint to corporate earnings pressure to equity valuations, and arrived at a conclusion that the current price levels in risk assets do not fully reflect the downside scenario that the energy situation makes plausible. The geopolitical dimension of the situation adds layers of complexity that make simple resolution difficult to envision. The United States has been conducting military operations in the region and has announced the deployment of additional naval assets, including warships, to the Strait of Hormuz. France and Italy have engaged in diplomatic negotiations with Iran aimed at securing passage through the strait for commercial vessels. The UK declined to deploy an aircraft carrier to the effort. Iran's terrain provides significant defensive advantages that complicate military calculations. The mountainous geography of Iran is fundamentally different from the open desert terrain of the Gulf Cooperation Council states, and it makes both offensive military operations and the assessment of Iranian military capability considerably more difficult than terrain-based analyses of other potential conflict zones. Iran has set explicit conditions for any ceasefire that include formal recognition of its legitimate rights, reparations for damages already incurred, and binding international guarantees against future military action from the United States and Israel. Those conditions are not conditions that the United States or Israel can accept without major concessions that carry their own geopolitical costs. The implication is that a rapid negotiated resolution is not the base case that informed observers are working with. The scenario that appears more likely in the near term is a prolonged period of elevated tension, partial disruption, and ongoing uncertainty, which from an economic standpoint may be nearly as damaging as a complete closure because it prevents the return of normal commercial shipping and insurance operations that the global supply chain requires to function. The history of energy shocks and their economic consequences is instructive and worth taking seriously as a framework for understanding what may be coming. The 1973 Arab oil embargo, which reduced global oil supply by roughly 5%, triggered a recession across the industrialized world, contributed to the worst inflation the United States had experienced in decades, and fundamentally reshaped the global economic order in ways that are still visible today. The 1979 Iranian Revolution and the subsequent Iran-Iraq War removed a significant share of Persian Gulf oil from markets and produced another severe global recession combined with double-digit inflation across multiple major economies. The 1990 Iraqi invasion of Kuwait, which temporarily removed Kuwaiti and Iraqi production from markets, contributed to a U.S. recession and required a massive military response to stabilize. In each of those cases, the supply disruption was partial, temporary, and ultimately resolved through military intervention, negotiated settlement, or the development of alternative supply sources over time. What is being discussed now in the context of the Strait of Hormuz is potentially of a different order of magnitude, both in terms of the share of global supply affected and in terms of the absence of readily available alternative supply sources that could compensate at the required scale within any near-term time frame. The global economy has grown enormously more complex and more interdependent since the energy shocks of the 1970s and 1980s. The supply chains are longer, the just-in-time inventory systems leave less buffer against disruption, and the financial systems that underpin the real economy are more tightly connected in ways that can accelerate the transmission of shocks across sectors and geographies. If the global energy system experiences a major shock under these conditions, the question of how resilient the current economic system really is deserves a more serious and more honest answer than the one that most official communications are currently offering.